But I want to kind of go with this topic around what the Fed does in the context of what the bond market itself is doing outside of the short end of the curve. Jim, let me start off with you on that. Should the Fed maybe hike rates, do the exact opposite of what the market thinks?
Well, when they cut rates in September, yields went up. And so that should tell us a lot right there. And what it tells us is, I think, is, underlying this is inflation and the fear of inflation and the fear specifically of tariff driven inflation right now. Jay Powell, I think, has been pretty clear in making the statement that if you tell me we're going to have higher unemployment and weaker growth, and you tell me that prices are going to go up because of tariffs or inflation in general, we're not going to cut rates. Good luck with your recession, or good luck with your higher unemployment. And I think that, to that end, if the market is concerned about inflation and it reacted negatively to easing last year, it might react positively to a rate hike by seeing the 10-year yield go down. Now, I could say that. You might agree with that. Good luck trying to get President Trump to buy into that kind of argument right now.
Jay, I'm curious your thoughts on what Jim said.
Well, so we have a differentiated view. We think the money supply matters. The Fed does not. Money supply is shrinking. So they've made comments that go, we're close to neutral. Complete lie in our models. Neutral is about 3%, maybe 2.75%. Housing market's slowing, construction's slowing. So we sort of feel the opposite. The best cure for higher rates is higher rates. So the 450 10-year, we're at 454 right now. The 30-year mortgage is at over 7. Could cause housing starts to go below 1.1 million. We somewhat tongue-in-cheek called our recession rule the Hatfield rule. You might have heard the Psalm rule. So what people don't realize is it's a free country, so you can have a Bianco rule and a Guyad rule. But ours is that when housing starts go below 1.1 million, that's precipitated 11 out of 12 post-World War II recessions. So we think the Fed's playing with fire. Our models show inflation is going to be continuing decline. We would ignore a 1 or 2 month blip because of tariffs, because it's more sales tax, which should be ignored. It's not going to recur. The Fed thinks it might, so that's what they may not cut. They're not going to cut until unemployment rises, or they see that there's only 1 or 2 months of higher CPI and then lower CPI because energy is plummeting.